Hello, and welcome to the Options Trading Desk. In this video, we are looking at the risks involved in selling puts. In the top right-hand corner of the screen is the details of the put contract, which will be the focus of the video. Our put contract has a strike price of $100, an expiration of 50 days, and a per share price of $2.50, which is multiplied by 100 to give the total price of $250. When a put contract is sold, the buyer of the contract pays the purchase price to the seller of the contract. In this example, the buyer would pay the seller $250. Let's examine the risk profiles of both the buyer and the seller. The maximum amount the buyer of the put can lose is the premium paid for the contract. In this example, it would be $250. This means the total risk for the buyer is $250. The risk profile for the seller of the contract is very different. When we sell a put, we agree to buy the underlying stock at the strike price if the buyer exercises the option. If the stock's price falls below the strike price, we may end up buying shares for more than their current market value, potentially resulting in a significant loss. In this example, the strike price is $100, but we collected a premium of $2.50, so our maximum risk is $97.50 per share. When multiplied by the 100 shares, that equals a total risk of $9,750. Now, let's examine the profit potential of both parties. The buyer of a put option has a potentially significant profit opportunity, as a put option allows them to profit from a decline in the underlying asset's price. In this example, the strike price is $100, but it costs $2.50 to purchase the contract, so the break-even would be $97.50. When multiplied by 100 shares, the profit potential is $9,750. The profit potential for the seller of the put is the premium collected when the contract was sold, which in this example is $250. So the maximum amount of profit the seller can make is $250. When we collect the premium for selling the put, we create a profit zone. If the stock price at expiration is within the profit zone or higher, we will be profitable on the trade. Let's take a look at three possible outcomes from selling the put. The first possible outcome is the stock price finishes above the strike price at expiration. In this scenario, the contract will expire worthless and we would keep all of the premium we collected from selling the put. The second possible outcome from selling the put is the stock price at expiration finishes within the profit zone. In this situation, we would be able to repurchase the put contract for a lower amount than we sold it for and profit the difference between the sell price and the lower repurchase price. For example, we sold the put for $2.50 and at expiration, we repurchased the contract for $1.15. We would then profit the difference of $1.35. When multiplied for the 100 shares, our total profit would be $135. The final outcome is the stock price at expiration is lower than our break-even of $97.50. In this situation, we would be obligated to purchase the shares of the underlying at the strike price of $100, and we would be liable for the difference between the stock price and the strike price. For example, the stock price at expiration is at $25. In this situation, we would have quite a significant loss. If we subtract the stock price of $25 from our break-even of $97.50, we would have a loss of $72.50 per share. When multiplied by 100 shares, the total loss would be $7,250. This is an extreme example of what can go wrong with selling puts, but it is not as uncommon as you would think. That is the risks of selling puts. If you like this video, please like and subscribe.